This is a Financial Times from late 2008. The S&P 500 graph is plunging, and the headlines are screaming about bailout rejections. Wall Street was in the middle of a generational collapse, bleeding money at a terrifying rate. But looking at a comparative chart of profit and loss for that same period, an anomaly appears. While major banks dropped deep into the red, one hedge fund generated a towering $15 billion in profit in 12 months. $15 billion, made in a single year by a single firm. That is a number that actually exceeds the total gross domestic product of several independent nations. The core irony of this record-breaking profit is how it was generated. Every cent of that money was extracted by betting directly against the exact same mortgage system that the biggest banks on earth were loudly defending as mathematically safe. The man who orchestrated this trade was not a real estate mogul.
He had absolutely zero background trading mortgages. This is John Paulson. Most of Wall Street barely knew his name. Paulson ran a fund focused on merger arbitrage, which is essentially placing very calculated bets on the outcomes of corporate mergers. It is a highly conservative, strictly analytical corner of the financial world. So how does an individual operating in one of the most cautious sectors of finance suddenly engineer the most profitable single trade in history? His advantage was his distance from the machine. Paulson was physically and culturally disconnected from the high-stakes echo chamber of the big banks. That separation allowed him to spot a massive structural flaw that everyone else was too busy profiting from to notice. If we wind the clock back to 2005, the American housing market looked invincible. Neighborhoods like this were springing up by the thousands, driven by a booming demand that seemed completely immune to gravity. The entire economic engine was running on a single shared belief. National home prices had not fallen in living memory, therefore they never would. Trusting that assumption, banks went into overdrive. They began approving subprime mortgages to people with no proof of income and no down payments. Then they packaged thousands of these highly risky loans together into single financial products. Finally, the major credit rating agencies would review these bundles of toxic loans, stamp them with their highest possible safety ratings, and send them out to global investors disguised as perfectly secure investments. The global financial system effectively abandoned risk assessment. The banks, the raters, and the buyers were all operating under a collective groupthink, where a broad decline in the housing market was treated as a mathematical impossibility. Back at his mid-sized fund, Paulson's conservative instincts kicked in. The euphoria of the 2005 market felt totally detached from the raw data he was reviewing. Looking at this chart of the housing momentum, Paulson started asking a question no one else dared to say out loud. What happens to this entire system if home prices don't violently crash, but simply stop going up? To answer that, we have to understand a mechanism called leveraged layering. Investors were using immense amounts of borrowed money to stack these mortgage bonds on top of each other, balancing heavy financial weight on a very narrow foundation. Paulson's research revealed a terrifying vulnerability. If home prices merely plateaued, didn't drop, just stalled, that alone would cause enough defaults to completely wipe out the bottom layer of these bonds. And because of all that borrowed money packed into the layers above, a failure at the foundation guarantees a catastrophic cascade. Once the bottom gives out, it pulls the entire multi-billion-dollar structure down with it. But having a smart suspicion doesn't make you money. To actually execute a trade, Paulson needed to turn his theory into a precise mathematical model. He needed an analyst willing to do the tedious work the big banks were ignoring. He found Paolo Pellegrini, a Harvard Business School graduate who had bounced between jobs and was struggling to find work when Paulson recruited him in 2004. Together, they locked themselves into an isolated workflow. They spent months grinding through obscure loan data, trying to map out exactly where the vulnerability in the market was hiding. This map shows the output of their model. They calculated exactly how much home prices needed to fall and in which specific regional zip codes to trigger that cascade and render those top-rated bonds completely worthless. Paulson and Pellegrini had successfully built a tool to measure the exact breaking point of the American economy. They did the basic math. The entire financial establishment was too arrogant to attempt. With the model finished, they held undeniable mathematical proof
that the market was a fragile house of cards waiting to collapse. The dynamic shifted completely. They went from being two skeptical outsiders to being the only men in the room holding the detonation codes for the global economy. But proving the market will crash is just a theory on a spreadsheet. Actually convincing investors to hand over billions of dollars to bet against an undefeated market, that is an entirely different problem.
Figuring out that the mortgage market was built on a fragile foundation was one thing. Figuring out how to actually profit from that information was another problem entirely. You can easily short a single stock if you think a specific company is poorly managed, but shorting American real estate, a decentralized multi-trillion-dollar asset class propped up by every major bank, requires a completely different mechanism. John Paulson needed a specialized financial tool that could scale with the size of his conviction. He found his answer in an obscure derivative that a handful of other contrarian investors were quietly testing out. On Wall Street, knowing a system is going to break doesn't pay out a single cent. You have to find the exact instrument designed to catch the pieces when it falls. That instrument was the credit default swap. Think of a credit default swap as a specific insurance policy. You pay a small monthly premium. If the mortgage bond defaults, it pays out an enormous sum. Because the market treated a housing collapse as mathematically impossible, this insurance was priced near zero. The cost to maintain the position was tiny, while the potential reward was nearly limitless. In 2006, Paulson launched a fund built entirely around this mechanism. He started accumulating billions of dollars in credit default swaps against the weakest mortgage bonds he could find. He had constructed a mathematical trap. If he was wrong, he lost a small, clearly defined amount of capital. If he was right, the payout would be catastrophic for the banks and lucrative for him. But the market refused to cooperate. Throughout 2006, home prices kept climbing, completely defying the structural rot Paulson saw in the data. The underlying bonds maintained their high ratings. That meant the trigger for Paulson's massive insurance payout remained entirely dormant. Every 30 days, those tiny insurance premiums came due. Millions of dollars bled out of the fund, month after month, paying for a catastrophe that seemed like it was never going to arrive. You can be entirely correct about the underlying math, but if you are 2 years early to a trade, the holding costs will drain your accounts before you ever get to prove your point. Outside the firm, the consensus was brutal. Colleagues at major investment banks openly mocked the strategy, viewing it as an arrogant miscalculation by someone who simply didn't understand the real estate sector. Inside the firm, the panic was tangible. Investors stared at the monthly statements, showing consistent, grinding losses, and they started pulling their capital to stop the bleeding. Even Paulson began to question his own thesis. By his own later admission, the isolation of being the only one betting on a collapse started to erode his confidence in the entire model. To counter the pressure, Paulson and his partner Paolo Pellegrini retreated into the raw data. They tuned out the trading floor chatter and manually tracked delinquency rates, state by state, loan by loan. Holding a position like this requires you to detach completely from human sentiment. When the entire financial system tells you you're wrong, your only defense is a stubborn reliance on the spreadsheets. The math finally caught up with reality in the early months of 2007. Subprime lenders across the country started releasing their quarterly reports, and they revealed a sudden spike in people failing to pay their mortgages. The mockery on the trading floors evaporated. The blind confidence in continuous housing growth was replaced by a very real, quiet anxiety, as banks realized the underlying loans were rotting. The delusion that property values could climb infinitely was colliding directly with the physical reality of thousands of Americans handing over their keys. Then came the flashpoint. 2 massive hedge funds managed by Bear Stearns suddenly went into liquidation. Those funds collapsed because they were holding massive concentrations of the exact same toxic mortgage bonds Paulson had spent the last 2 years betting against. In an instant, the mechanics of the trade reversed. The agonizing monthly premiums stopped mattering, and the credit default swaps were activated. The punishment for being early was finally over. Now it was time to collect the payout. In February of 2007, the investors backing Paulson and Company opened their monthly performance statements. When they looked at their monthly return, most of them assumed someone had made a clerical error. The number didn't say 6.6%, it said 66. Outside those Wall Street offices, the first serious cracks in the American housing market were starting to show. Delinquencies were creeping up, and foreclosures were becoming visible in neighborhoods that had been booming just months earlier. But for the previous half-decade, the market had operated on a single, universally accepted premise. American housing prices only go in one direction: up. The entire global financial machine, trillions of dollars in complex derivatives and institutional balance sheets, rested completely on that specific assumption, and almost nobody in power saw a reason to doubt it. John Paulson was one of the few who did. For 2 years, he positioned his fund to profit if the market collapsed. He wasn't a mortgage broker. He had no background in real estate, and he didn't belong to the structured finance inner circle. He simply looked at the massive inflation of home values and asked, what actually happens to this financial structure if these prices stop rising? For his curiosity, he was met with relentless skepticism. For nearly 24 straight months, while he paid out millions in insurance premiums to maintain his position, the market told him he was dead wrong. He didn't have a proprietary algorithm or inside information. His edge was entirely psychological. He was fully willing to bet against a truth that everyone else had accepted as a law of physics. The instrument he used to make this bet was called a credit default swap. In plain terms, it's essentially an insurance policy that pays out if a specific bond defaults. Paulson structured this to be heavily asymmetric. He paid relatively tiny, predictable monthly premiums. If the market kept going up, he lost a little bit of money. But if the bonds collapsed, that flat line of premiums would turn into a massive vertical payout. By the summer of 2007, the trap snapped. Mortgage bonds that rating agencies had labeled as perfectly safe plummeted toward zero. By the time the year closed, those credit default swaps had generated roughly $15 billion in profit for Paulson and Company. To put that in perspective, George Soros broke the Bank of England in 1992 and made $1 billion. Paulson's payout was 15 times larger. His personal cut of those profits was estimated at nearly $4 billion for a single year of work. He out-earned the combined wealth of the highest-paid athletes and entertainers on Earth. That first phase was an exercise in extreme patience, but incredibly, he wasn't done. As 2008 kicked off, the rest of Wall Street was reeling from the housing crash. Paulson, however, reloaded. He moved his target from the housing market to the financial institutions themselves. He started shorting the banks, like Bear Stearns, that held massive portfolios of the exact same toxic bonds he had just made a fortune betting against. Often, he would take investor meetings and sit directly across the table from the executives of the very firms his fund was actively betting would collapse. Over the next several months, the institutions that packaged and sold the subprime crisis began to buckle under their own weight. This newspaper front page shows the sheer panic of late September 2008. When Congress initially rejected the massive bank bailout, the S&P 500 charted its worst single day since 1987. As the banking sector crumbled, Paulson's second targeted strike yielded another $5 billion in profit. Going after the actual architects of the crisis is what turned a highly successful bet into the most lucrative sequence of financial maneuvers in history. Across 2 years of carefully calculated strikes, Paulson pulled roughly $20 billion out of the collapsing market. You don't pull off a trade of that scale with a crystal ball. You do it by looking at an assumption everyone else is perfectly comfortable with and choosing to interrogate it. This chart illustrates his financial structure. The tiny red bar is his capped cost of being wrong. The massive green bar is the reward for being right. Capping that downside let him sleep at night, knowing his upside was infinite. The major banks were operating on the exact inverse of this model. They were taking small, steady gains on mortgage fees while exposing themselves to a hidden, absolute catastrophe that ultimately wiped them out. Looking at the modern financial system today, the obvious question remains: what deeply held assumption is propping up the current market simply because no one wants to ask what happens if it stops?
John Paulson didn't map the subprime collapse because he possessed a higher financial intelligence than everyone else. He mapped it because he was willing to doubt what everyone else had simply stopped questioning.